Here we are, the last day of February. Looking forward to spring right around the corner. I'm sure you are too. It's always a nice bump in the housing market with a little bit more inventory, hopefully, as we go forward into the spring and nicer weather, of course. So today I just wanted to kind of recap here, show you the charts for the month, the last couple of months, and so you can see what's happened. It's been kind of a disappointing February, honestly, when it comes to mortgage rates. They have gotten worse throughout the month, especially the last couple of weeks. But we are looking forward to better times ahead in March, and I'll show you that here in a second. So let's take a look here. As you can see, the U.S. 10-year Treasury, which is kind of a leading indicator of mortgage rates, hanging in there about the 3.9 range, staying below 4 as a ceiling. 4 seems to be a ceiling there. I'll show you the chart on that real quick. 4%, it continues to get bouncing off that ceiling up here at 4. So we're sure hoping this hangs in there, obviously, until we get some better data. So what happened in February is we got some, of course, data on the employment front that was hotter than expected, partially because of a population control factor that the BLS included for January's data. And that caused us to show, over 500,000 new jobs, when in reality, if you didn't have that in there, it would have been less than 100,000. So that would have been better. And the bond market wouldn't have taken that at face value like it did. We also had some inflation data. CPI came in lower again, continues to improve, but not as low as the markets expected, which caused, of course, interest rates, the bond market to react negatively. So that's what's happened here. You can see this all the way from the beginning of February. We've had just this rise in yield and rate, right, on the 10-year Treasury. That's translated equally. I'll show you here on the MBS Highway. This was not MBS Highway, the MBS, Universal Mortgage-Backed Security Bond Market. This is the 30-year Fannie Mae Freddie Mac conventional bond. This is the opposite. This is inverse. You look at the opposite of the 10-year Treasury. So the price here has declined. If price improves, then yield and rate are declining. So in this case, you've seen since the beginning of February, price declines because of all this news. Now, over the past week, we've stabilized, right? We have a little bit of a floor here that is not going below. And so this week, we don't have a lot of new data out there that could be market moving, except that the various members of the Fed will be speaking sometimes, depending on how hawkish or dovish their comments are. That can move markets a bit. So that's the only thing that could really affect markets too much this week, unless there's always the opportunity for a black swan event, wars or something like that pops out of nowhere. But absent anything like a black swan event, really the only market moving data for this week is the Fed. Now, beyond that, going into next month, we are looking forward to new data on inflation coming out by March 14th. So as we get new inflation data by March 14th, that's kind of the date circled on my calendar. We're hoping to see that continue to improve, to lessen, which will help improve mortgage rates, help improve the bond market, and things move forward. So hang in there. I think better times are ahead, but we don't know by how much, right, or exactly how that's going to affect it. But based on data and the fact that we have lagging indicators that are still catching up, like housing, for example, in the inflation data, if you remember last month, the housing data is always a lagging indicator. There's this thing called apartment list out there that keeps track of more current rentals in a lot of the big cities, and that seems to be continuing to drop. But housing data on the inflation report is lagging. It makes up about 40% of the consumer price index, the housing data, but that's lagging because of the leases that people have already entered into. So that should be rounding the top, right? The roller coaster top should be coming down, and that should be catching up and starting next month, hopefully, and then going forward in the months after that, reflecting lower housing costs, which is such a huge component of that consumer price index. So that'll help continue to drive inflation down, which should ease interest rates again as we go through the rest of the year. But let's start with March 14th and shoot for that, and then we'll go from there. I know May, there's also a big circle on my calendar for May as well, when we have more data that comes out that could be very influential in helping to drive inflation lower and improve interest rates. So with that, have a wonderful day. Look forward to hearing from you. If you have any questions, feel free to call, text, or email. Talk to you soon.